Thank you for having us. I'm Chris Moynihan, and I met you all last time, but for those of you that didn't get a chance to meet me, I am an investment banker. I've been doing it for 11 years, and I've been involved with Wise as well, which has this wonderful partnership with the Savvy Lady. So excited to be with you all today. And I'll let Gabriel introduce himself and take it away from there.
Sure. I think I met some of you, if not most, a couple of weeks ago when we touched on the goal setting exercise slash, lesson. But for the ones who didn't meet me, my name is Gabriel. I work in finance. I've been doing the same thing for 6 years. And I've been involved with Wise the same amount of time. I mentioned before that I love teaching. I'm part of the associate board. I've done not only this program with Wise, but other programs, and MoneyWise is by far my favorite one. I also want to be a professor later on in my life, so I actually really enjoy teaching people. Special financial literacy. It's kind of where both of my interests kind of, intersect. I think what we're gonna do here is I'm gonna be teaching kind of like call it first half of this lesson plan and then up to an activity, and then Chris is gonna take it from there. Before I begin, who has Chris, are you portraying those slides on my end or is
I I am. Do you want me to do you want to share the slides so you can go at your pace and then we can switch? I'll
yeah,
stop.
that's fine. I can do it. One sec. I just don't want you to be burdened with that.
No problem at
Okay.
all.
So let's see. Before I begin, I just want to make sure like everybody's able to see my slide. If somebody just does like a thumbs up, that will be for me. Okay, perfect. Cool. So, today's topic is I'm a nerd in financial literacy. It's top three of my favorite topics. If you ask me, well, what's top one? It's taxes. I unfortunately won't get to teach that one because of other, um, extracurricular activities I have to run with. But credit card and debt management is certainly up there. It's one of my favorite topics because I think a lot of people have these kind of like negative feelings towards credit cards because they think of credit cards as debt. And I don't think those two items are synonymous. As a matter of fact, you can certainly use credit cards for your advantage. I know a lot of people, including myself. I worked a little bit on the credit card game myself, so it's super helpful, and I'm happy to share those insights today. Um, so what are we gonna cover today? So we're gonna talk a little bit about like credit cards. Most importantly, reading a credit report, like understanding when people think about, credit scores. I think people generally think and know what credit scores are, but they don't necessarily know what the components of the credit score are. So, in order to improve your credit score, right? Because I hope everybody wants to improve their credit score, you need to understand the components to make sure that you're focusing on the right areas. So that's gonna be part of it. And then also kind of like debt management for those in the audience that have debts. We're gonna help you think about like how should you, make a debt consolidation plan. How do you think about like the different streams of debt that you have? It can certainly be super overwhelming. There's some with like education debt, some have like, credit card debt, others have, personal loans, like all those type of debts and how to kind of like think about them to make sure that you tackle it appropriately. Um, so, okay. Um, cool. Um, I know that last class after we did the goal setting exercise, you guys probably spent another class talking about um tracking your spending and looking at things that like maybe surprise you. I will share a quick story, then I want somebody a brave volunteer to maybe say one item that really surprised them about their spending as soon as they started tracking it. So for me, um, although it sounds very, very basic, you will be really surprised at how much you spend on coffee. Just like daily coffees. I did like a 3 month analysis of my coffee expenditures, and for lack of a better word, I was very surprised. Because it's just a menial expense, especially because it's small, right? Like in your head, you're spending $5 depending on where you live a day, so you're not thinking too much about it. But of course, $5 across time really adds up. So I was, pretty high up there, spending a lot of coffee, and that's kind of tying back to my story. I don't know if you remember on the first class where I said like I look at that expenditure of coffee, and then I bought a machine because basically I would be getting my money back on the machine in like a few months. And then after that, I would just be technically in my head saving money because coffee is a necessity for me. I wake up, I'm really sleepy, I need coffee, I need two a day. So that's something that like is the non-negotiable in our spending plan, if you may. So that's something that really surprised me. I'm gonna stop there. See if anybody is brave enough to share any sort of expense. It could be anything that you were really surprised about that you find in your spending plan to be like on the higher end, probably. Anybody? You can just unmute yourself. Don't be shy.
I've got one. This is Sally.
Hi, Sally.
Hi
Perfect.
there. So it didn't surprise me so much, but I had a feeling I was spending more than the average person on my haircuts and colors. I just
Interesting.
felt like it was really high. Um, and so I looked at my budget and realized I could cut so much money out of my annual budget if I found a new salon or if I went somewhere just for a bang trim rather than going back to my hairstylist, like even going to Great Clips for a $10 bang trim versus doing that somewhere else. So I think that's an easy one for me to do. Just have to find a new stylist, but I was spending too much and I could really cut back on that. So that was one of mine.
That is so interesting. Yeah, I think like, some people have like an emotional attachment to their, hairstylist or barber and whatever. So they tend to have that as a sticking point and be like, there's no way I can change. This person knows my hair. But like potentially if you're changing or moving places already, that's something that I've seen. People really don't have a barber. So like or a hairstylist. So when I first moved here, I was literally moving all over the place to try to find like somebody that I was comfortable with, both from like, a quality perspective, because that's important. You don't want the quality to decrease just for saving money. But at the same time, you do want to make sure that you're cognizant about it. Like if, for example, you're spending $100 and the one next door is not gonna be that different quality and it's gonna be like $50, you most rather do the $50 just because it's not two times better. Another thing that I kind of found as a hack, well, my wife does it sometimes, and she, here comes showing me that she's saving money. I still don't believe it, but she started doing like her nails herself sometimes, like over a month or something. I don't know the cadence. Again, I don't paint my nails, but I do know that like it's done very frequently, and like if you go to the salon every time you have to do your nails, it becomes a really expensive affair versus like mixing and matching. Like one time I will do it, another time I'll go to the salon, and that way you can like maybe save 50%. That's another trick I learned, maybe more applicable for the ladies. Okay, that's super interesting. I'm glad that you found something useful out of it, and kind of part of it is what I was trying to say in the first class. Keeping yourself honest, making sure that like you're looking at those, I call it areas of development in your budget, right? Like you see something that you thought you were spending too much on, right? You never see something that you're like, oh, I'm spending too little, let me spend more. You usually find two or three items that you're like, oh my gosh, I had no idea I was spending that much money. So that's always really, really good and helpful to realize. Okay, So to the nitty gritty, credit. Um, so we can use the slides, and as I mentioned, my style is like very simplistic. I'm gonna like uncomplicate things, make sure that like it's in very plain English in front of you, and you can, most importantly, after this class is done, remember everything. Credit, I think most of you are well accustomed to the term, but basically it just means that there's a amount of money that is available to you that you don't have to pay immediately. That's literally the easiest way of thinking about it. That is for a credit card, it's true on a monthly basis, you don't have to pay it. For a loan, depending on how long the loan is for a mortgage, if you have to think about it, right? Like you're paying every month a little bit of the mortgage, right? But at the end of the day, it's just an amount of money that was available to you day one that you do not have to pay back day one. That's the easiest way of explaining. Now, the flip side of accessing money day one is it costs money as well. As crazy as that sounds, right? Like a bank or a financial institution is extending you credit because they have made a determination that you're credit worthy enough to lend you XYZ amount of money, but they want to be compensated for that risk. And the way that they get compensated for that risk is your famous interest rate. And that can vary person by person, mostly as a factor of like your credit score plus minus the specific terms of the money that you're asking for. So then the natural question is like, okay, I understand credit. How are some of the forms that like on our daily lives we access credit? The easiest way to think about is credit cards. I think everybody knows that the moment that you make a purchase for Black Friday, for example, that happened last week, you didn't have to pay dollar for dollar that day, right? That is the easiest way of thinking about how you use it in a credit card. To be clear, and some people sometimes get confused, and I just want to make sure you're aware. You have credit cards and you have debit cards. Two very distinct items that serve very different purposes. But the main difference is, as I mentioned, credit card, you purchase day one, you don't owe until your statement closes. Debit card is usually linked to your checking account, right? So you have to have the money day one. Or, you know, maybe be declined because if you have insufficient funds as a factor of like your checking account, then maybe you won't be able to purchase XYZ item. The good news about the debit card is like, of course, it's your money that you're using. But instead, the question is, well, why would you have a debit card, and not have a credit card if, the credit card seems to not be pay date one, but the debit card, you have to have the money? Great rhetorical question. So let me answer that. The reason that you have a debit and a credit card are for different purposes. So you want to think about responsible spending back to your budget, to your spending tracker, etc. So when you're using a debit card, you know that that's linked to your checking account. You know that you don't owe that money. It's not gonna carry any interest because it's linked to your available amount of money. So maybe you don't have to deal with, the complications of like tracking your spending and etc. because it's your money. But the main benefit of having a debit card is, what is the other option? You carrying hundreds of dollars around to make purchases all over the place and getting change back, and like, a debit card simplifies that process. So that, I would say, is the main reason why people today have debit cards. Credit cards, on the other end, is when used responsibly, very good because, think about like you get a 30-day interest-free loan. That is the best way of thinking about a credit card. And you're saying, well, how come it's 30-day? Like, how do you know that? Well, the reason is you can make, assuming you can pay off everything, you can make as many purchases on your credit card as you can afford. And when the statement closes, there's going to be a balance on the credit card that is going to equate to all those purchases. If you pay that all in full, you don't owe any interest. So that's why I say it's like a 30-day interest-free loan if you're able to use it responsibly. If you carry the balance and your next statement closes, then you're gonna be charged interest. And that's kind of like the tricky part. And probably people don't want to deal with that, and that's why they don't have credit cards. But I use it knowing that I use the golden rule. This is the Gabriel golden rule. If you cannot pay at the end of the month your purchase, or you can't figure out a creative way of paying, because that's another thing. People will be like, oh, if I move from here, move from. No, no, no. If you cannot pay off the purchase that you're about to make at the end of the month, stop. You shouldn't do it. That is the golden rule. Because if you're not able to pay it off, as I mentioned, you're going to incur interest on your purchase. And that's just going to compound and compound. We will talk about it in a second. Okay. So probably the main way of accessing credit is credit cards. You have your affinity card, your retail store credit cards, your mortgages, very important, right? Like, as I mentioned, like when you're purchasing a house, unless you have the full amount day one, you're probably getting a mortgage on your house, which basically means I will give you my house if I am unable to pay every month on whatever the terms are, right? So that's a way of accessing credit. And then installment loans, like for you, those of you that, for example, lease cars, right? Like, just to be clear, when you lease a car, that car is not yours. That car belongs to the dealership, right? You have an option to buy it at maturity when your lease ends, but that is another way of credit, because think about it. If you're unable to pay on your lease, the dealership will take the car. So yes, they didn't lose the car, but the car was driven, I don't know, 10,000 miles, and you couldn't pay on how much use you got out of the car. So they're taking a loss on the use of the car, if that makes sense. That's kind of like the real credit that they're giving you. You're paying for using the car. That's what a lease is. And then, student loans, right? Like you go to college for 4 years, incur hopefully no interest depending on the loan. At maturity, once you graduate, you start accruing interest on your loan and you have to pay it off. So those are all ways that people, day to day access credit. Um, Before I begin to the type of credit, I want to make sure that more importantly, the golden rule of credit cards is like fairly understood. That makes sense. Any, initial thoughts slash questions about anything that I've mentioned so far? Okay. So now we're gonna demystify a little bit the types of credit. A lot of buzzwords, a lot of things throwing around, I don't know, I can't count enough times when I go to the commercial bank like a Chase and I sit down with a banker and they're telling me all these different things and I'm like, my head is this big because I'm like, I don't really understand what you're saying. People end up making decisions without understanding what they're saying, and then they end up with a problem, correct? So that's probably not the best case scenario. So the objective here is that try to demystify some of those buzzwords. Um, so installment credit, okay? The slide says it's borrowed money, is received in lump sum and repaid over a specific number of equal payments, more regularly student or auto loans. So let me put an example, okay? So when you get an installment, that just means that every payment every month is, assuming you don't miss them, it's gonna be the same. So if I put an example, let's just say that you get $1,000 in installment loan to, buy a car. It doesn't really matter. And then you're gonna pay $100 every month. So technically, you will pay it off in 10 months, correct? Of course, there has to be some interest and etc. But I'm just making sure that you understand kind of the concept of an installment. If all goes to plan and you make $100 payments every month, you're gonna be paying off your loan in 10 months. The question is, well, what happens if 1 month I didn't make a payment? Will I owe $200 the next month because I owed 100 from last month and 100 from this month? The short answer is no, because what the kind of like financial institution that is lending you money is going to do is they're going to take the $100 from last month, and that's going to accrue interest over the whole month that you didn't pay, and that's going to be added to your extra $100 that you owe this month. So it is safe to say that you will owe more than $200 because it's the $200 of like principal or normal balance on the loan, but you're also gonna owe extra interest from the unpaid month that you had. That's kind of the main reason that I said in a weird way, this all comes full circle. The credit card, as I mentioned, you if you are not able to pay it in 30 days, that is the reason that you shouldn't make that purchase because the interest is gonna accrue. So let me put an example so you can visualize how big this interest can get. Now, same example, you have $1,000 loan, right? Divided into 10 installments of $100, okay? Easy. Now you have a 10% interest rate on the unpaid balances, okay? Now, first month, you made your payment. That's fine. Second month, you didn't make your payment, okay? So what's going to happen is on the third month, when you're going to make your third payment, you owe $100 times 10% interest on that $100 by basically the way that it works is the days that were unpaid go on the numerator, so that's 30 days, and that's going to be divided into 360, which is the normal days in a year. So it's 1 month, right, that you unpaid interest, and that's going to come up on top of your $100 from last month. So that 30 divided into 360 times 10%, it is more than $100, I will tell you, because it's $100 plus your unpaid interest. If we do a quick math, it's gonna be exactly 30 divided into 360 times 10%. It's gonna be like $110, like 108. It doesn't really matter. My point of my example is to show you that any unpaid balance is gonna carry interest. And then guess what? Let's say in the example, then the next month, the third month in this example, you're also not able to pay. Guess what? Your balance was 100 at the beginning. You didn't pay that. Now it's 200 plus the interest from last month. On the third month, that interest is gonna be again compounded because it's gonna take 200 plus, let's just say the $10 of interest that you owe, that's 210, and that's gonna be like your starting balance to continuously compound. So you could see how from like 100 to 200, then it grows to 210, then it grows to 220, and you see it's just like a domino effect because the interest that is calculated is as a factor of your interest and um sorry, as a factor of your balance and your unpaid interest, not only your original balance. So the amount is just gonna continue going up. It's like a growth rate, right? Like if $100 grows 1% every year, right? Um, and you start with $100. At the end of the year, you have $101. Now you're gonna get the growth rate of 1% on $101, not on 100%, not on $100. So that is the whole reason that I say you should pay your loan on time, but also if you're using credit card, you should pay it on time. If not, it's probably gonna be very uneconomical. Um, Revolving credit just means a line of credit that remains available over time. That's a little different than an installment credit because installment credit, I give you the $1,000 today, you have 10 months to pay it. Revolving credit means I will give you $1,000 to use at your leisure. So the difference is if I gave you $1,000 today and it was an installment credit and you spend $1,000, do you get $1,000 again? Imagine I gave you a loan for $1,000 and you just bought a car, $1,000, you're out. Your loan is you don't have any more money on the loan. You just have to, pay whatever the interest was. Would you get another $1,000? Short answer is no. Now your revolving credit is very different. You get $1,000, you use $1,000 to buy the car, and then you pay your loan back. It's like your credit limit, right? You have $1,000 to spend in your credit card. You use 500, you pay it off, it goes back to $1,000. You use 500 again, and then you pay it off, it goes back. So that's the concept of revolving. It's available at all times, assuming you pay it off. It's like replenishing versus the installment is like once and done. You would assume, and it's fair to assume on average, the installment credit is probably gonna be a higher amount than the revolving credit. The reason is the revolving credit, you have the ability to pay down and borrow again, versus the installment credit, it's set and done. So think about like an installment credit is more like for an auto loan, right? Like how much is an auto loan? Tens of thousands of dollars, right? Versus a revolving credit on your credit card is probably not tens of thousands of dollars, right? Because they know that if you pay it off, they have to replenish that amount. Versus the way that the financial institution thinks about the installment credit, they are like, oh, if they pay me back, I don't have to replenish it. So I'm out of the risk. Versus revolving, it's like it has to be available at all times. So I have a constant risk of you not paying me back. That's the easiest way of thinking about it. Um, and then before I stop for another round of questions, I want to make sure this is really clear, which is the treatment of credit. This is really, really important. This is pretty much my my job, kind of ish. Like I lend money to corporates in a way, so I have to think about this like very, very consistently and constantly. So secured and unsecured. Your mortgage, okay? If the loan that you're getting has an asset behind it, an item, it is a secured loan. If the loan that you're getting does not have an asset and solely relies on Gabriel's ability to repay back, it is unsecured. I'm gonna put some examples of loans, and I want people to tell me if they think that's unsecured or secured. And I know I'm not gonna put an example that is here because that's cheating. I'm gonna put a credit card. What do you think a credit card is? Secured or unsecured credit?
Unsecured.
Exactly. Right? If you don't pay your credit card, think about it. You don't pay your credit card, can they go after your house? Can they go after again, plus or minus after a lot of proceedings and if you declare bankruptcy, maybe yes. But for simplicity purposes, no. Okay? They can't liquidate your house if you don't pay your credit card bill. As much as I would, want to tell you that to have financial health in your life, they do not. Now, and I think you're very well aware of this. If you don't pay your mortgage, what happens to your house? What is
They're
the bank
coming to
gonna do?
get your house.
Exactly. So that is
Um,
secured.
yeah, it's secure because I'm trying to. I'm sorry. Was it secure?
Yes.
Like I understand. when you're talking, but I can't get it out.
No, no worries. Um, I can take a step back. That's a valid question. So the way to determine if a loan is secured or unsecured is you have to ask yourself this question. Can the person that loaned me the money go after an item? Or, said otherwise, is there an item or asset behind the loan? If the answer is no, then it is unsecured. If there is an asset and the answer is yes, yes, there is an asset, then the loan is secured. So if I go by that, you ask yourself this question. It's a little hard to wrap yourself around at first, but just ask this question. Is my mortgage loan, is there an item behind my mortgage? Then if you say, yes, it's my house, then it is secured. Does that make sense?
Yes. Thank
Yeah,
you.
no worries. Just always ask yourself that question. That is the best way. At first, I used to get caught up in like that, and then I start asking myself that question. I'm like, this is so is much easier to understand. Okay. Um, let's go with the next example. Oh, somebody asked raise their hand. Go ahead.
Yeah, so basically, secured is it's the institution that's being secured.
Um, the loan is being secured. The institution is lending you money with the condition
Right,
of you putting that item behind the loan.
right. I'm just thinking the way of remembering it is that it secures that they're getting their money back or the item back.
Yeah, that's
By the
very
way of
eloquent.
describing
That
it, I
is a
was just
good
thinking.
way of thinking about it as well. Like I don't get but that's from the viewpoint of the institution to your point. I was thinking it from your view, like how you think
Yeah.
about it. But if you flip and you're like, if I am the institution, the question I am asking is, if I don't get my money back, can I go after X item? If the answer is yes,
Mm-hmm.
then it's secured. If the answer
Yeah.
is no, then it's unsecured.
Thanks.
Correct. Of course. So same with the mortgage example, it's an auto loan. So if you get an auto loan, um, it's you pledge your car as collateral. Collateral is just basically saying, this is the nice way of saying, you can have this item if I don't pay you back. Um, and I don't know if you have a more practical kind of way of thinking about this, but I will give you another example, which maybe, you know, some of you may have heard of pawning an item. Anybody ever pawned an item? If somebody has ever pawned an item, that is literally secured lending, right? You go to a pawn shop, you take your gold chain, and you're like, here, and they evaluate it and they are like, okay, this is worth, let's just say, $1,000. I'm not gonna give you a loan for $1,000 because if you leave, I won't be able to sell this for 1,000. I want my money back. I'll give you a loan for $500. If you don't pay me back, what happens to the gold chain? The pawn shop stays with the gold chain. So that is a very easy way of thinking. And the gold chain that you gave the pawn shop is your collateral. You're literally saying, if I don't pay you back, just keep the gold chain. Okay? That is the easiest way of thinking about it. Okay. So sources of credit. Oh wow, here's the pawn shop. That's crazy. This is not super important. Why use credit? I think we covered that. Why use credit cards? This I will cover it, and how to establish good credit. risk of using credit and paying the minimum amount. Okay. Think I established already a test case for using credit. Um, oh wait, I got a question. So personal loans can either be secured with collateral or unsecured. Correct. Most likely, a personal loan will often be unsecured, actually. So that's why it's hard. Like, if you think about, like, oh, you qualify for a personal loan, that means that they're willing to see you as the borrower without any items behind it and willing you to lend money. Rarely will there be a collateral on personal loans. The easiest way of accessing a personal loan with collateral is through a pawn shop. That is the easiest way of thinking about like a personal loan with collateral. But it's usually unsecured. Um, okay. So why use credit cards? I think I covered most of it. I think A, not to be dealing with all the money change in your pockets, especially now that like items are weirdly priced, sorry. And you always, one time I remember I had like $5 in dimes in my jeans and they were falling down because it was so heavy. So I was like, credit cards or debit cards in general are easier just to manage spending. Emergency buying power. That's important because, as I mentioned, it's money available to you day one with the uh, you know condition that you pay within 30 days. If not, you incur credit card interest charges. Additional form of identification, plus or minus. Records of purchases on bill statement. That's really important. That's actually the second reason I use it, which I will touch base on the first one in a sec. But when you're tracking your spending, imagine tracking your spending like old school with the pen and paper. That's gonna take you a lot of time. And it's maybe you're gonna be prone to mistake because you have to be asking receipts everywhere and etc. Think about like if everything you purchase with a credit card or a debit card, you can just print your bill statement and look at how much you spent. And some of the bill statements even categorize it like restaurants, whatever. Like it's really like well done now. Like it's come a long way. So it's very easy to track your spending with like a credit card statement or a debit card. But the main reason, that is what I talked about, is the discount and reward programs. As I mentioned, there are credit cards that have, I'm pretty sure you've heard this phrase. It's called the annual fee. Basically, every year you pay a fee to keep the card. But there are credit cards that do not have annual fees that also have a lot of benefits. And as I mentioned, like cars that have or do not have annual fee doesn't mean anything. Like doesn't mean one is better than the other one. You just have to look at your particular situation. But an easy way of thinking about it and putting it into context, I'm gonna leave you with this as a quick example, is let's just say that you were a crazy foodie and you love going to restaurants all the time. Like that's a thing you do, right? And then you see a credit card that has an annual fee of $100, okay? And you're instantly like, oh my gosh, this credit card is $100 annual fee. It's not worth it. Well, it depends. The reason I say that is if you look at the annual fee, it's $100, and you look at the rewards that brings you for your specific expenditure, which is restaurants. Let's just say it gives you 5% back on all restaurant purchases. Okay? The easiest way of calculating if this credit card is worth it for you is you look at your last year expenditure in restaurants. And let's just put an example. Let's say you spent, I'm just making a number, $10,000 in restaurant. Oh my God, you were eating out all the time. It was insane. But that's a thing that you do a lot. So you were spending $10,000 a year on restaurants. And with this card, you get 5% back, right? On restaurants. So if you multiply 10,000 times 5%, you get $500 back. So if you compare your expenditure times the rewards that you would get being 500 and your annual fee being $100, wouldn't that mean that you're getting 5 times the annual fee in a year and it's probably a good thing to do? That's an easy example of like how to think about like rewards programs and like cashback and etc. in the context of annual fees. In the context of no annual fee credit cards, you don't have to care about the annual fee. You just have to look at the rewards and make sure that like it's appropriate for you. Because every time you apply to a credit card, there's gonna be a pull on your credit report. There's other factors that are gonna be affected that I'm gonna touch base upon, that are considerable when applying. Um, so I think this is straightforward. Like, to establish your credit, you have to make sure that like you're paying your debts in time, you're not carrying balance on your credit cards or interest, you have no default, no bankruptcies, etc. Make sure that you have the finances in order. I think this is self-explanatory. I think in terms of the risk of using credit, I think if you live by the golden rule I taught you, it covers plus or minus these 7 bullets. You should always buy something you can afford on a credit card. If you can't, don't buy it because you're going to incur interest. And like, it's not, and your item is just going to become more expensive. So if you bought $100 item and you're doing 20% interest on your credit card, and you couldn't pay the $100 at the end of the month, you're gonna incur 20% of interest, and now you don't owe $100, although your item was worth $100. Now it's worth 105, and so on and so forth. As I mentioned, it's gonna compound and grow and etc. Next thing you know, you're paying $200 in interest because an item that you purchased, you didn't pay it on time. So I think you live by the golden rule, you should be fine, to kind of be able to use a credit card wisely. And then the other kind of thing I think most people don't know is credit card is not the same. I don't know if you heard the term advanced cash payment, but basically means like if you have a credit card with a limit of $1,000 and you want 100, like credit cards only work to make purchases. If you wanted actual cash out of your credit card, that is a separate interest rate and it's more expensive. So I would never advise to do that. But that's why like here it says expensive way to borrow due to high interest rates. That's if you cannot pay whatever you're purchasing, but also if you're trying to get an advance cash on your credit card, very, very expensive. So those are the two main caveats. Then I think and this is gonna tie into our activity in a sec, but paying the minimum amount is the kind of like, this is what I'm gonna explain. What is the minimum amount? The easiest way of thinking about it, this is very important. So try to conceptualize it, kind of like back to the idea of secure versus unsecured and like asking yourself a question. So this doesn't have round numbers, so let's just use round numbers. Um, let's just say that you have $1,000 that you owe, and then there's a 10% interest on the $1,000. Um, Now you incur interest unless you make the minimum amount payment. Otherwise said, the minimum amount payment is the minimum amount of money that you pay every month, so your interest doesn't keep increasing. That is the easiest way of understanding it. So ideally, you're able to pay your balance, okay? But if you're not able to pay your balance, you at least should pay your interest, your minimum amount, because in that way, you avoid your balance to continue grow. So let me put the example so you can conceptualize it. This is actually not that easy to conceptualize, and this is kind of our activity, so we're gonna do it in a sec. But in my example of $1,000 with a 10% interest, let's just say that the minimum payment is 5% of your balance. So let's just say you have $1,000 credit limit, you use your $1,000, okay? Your statement post, and now you owe $1,000, correct? Fine. You're not able to pay that. Your second statement is about to close, your second month now. And your minimum payment is 5% of your balance, okay? So what is 5% of $1,000? Is $50, okay? That means that if you pay $50, your next statement balance is gonna be $1,000 again. If you do not make those $50 payment, your next statement balance is gonna be $1,000 plus the $50 that you owe, and they're gonna calculate interest on those two items. So all you're trying to do with your minimum payment amount is making sure that the interest doesn't go and continue growing on top of each other. That is the magic of using the minimum payment amount. Again, the minimum payment amount is easier to mitigate at the beginning. So if it's you miss the first month and you have a minimum payment amount, that's where it's most effective. If you haven't paid your credit card balance for 10 months and you keep making the minimum payment amounts, your loan is not gonna grow beyond the 10-month mark to the 11-month mark. But the 10 months that you have unpaid, that's gonna continuously grow. So that's why people are like, oh, you should always do more than your minimum payment. That's in the case that you have multiple months. But if you only have 1 month and are about to miss it, you should do the minimum payment to make sure that like you're making up for the lost month. Um, this is explanatory. Let's do the activity because this is gonna put it into context, and then I can give Chris time because I have taken much more than what I thought. Um, so okay. So this is how to read a credit card statement. This is gonna be super participative. So we have it here, and we're gonna ask some questions. So you have the same amount of information as me, okay? First question is, what is the total amount owed on this credit card? Who has the answer?
$2,000.
Perfect. Perfect. Wow, I'm very surprised somebody got it on the first try. That's really good. That's very, very good. It's here. So why the question is for the ones that maybe didn't arrive at the 2000, well, how do you know it's the $2,000? Um, the answer is this is your previous month. Then, as I mentioned, you made $50 in payments, you made $100 in transactions, so your balance is gonna increase from 1,885 plus 50, right? Because it's the difference between these two. Fees charge, that's gonna go up 25. Interest charge up 40, and that's how you arrive at the 2000. So it's not only your previous balance, as I mentioned. This is a way to conceptualize what I was talking about. If you do not make your minimum payment, this is what you're getting continuously charged, and it's gonna continue growing. So this is what you're avoiding with the minimum payment. You're not avoiding this. You will always owe that. You cannot decrease that unless you start paying more than your minimum payment. That's what people are saying. Okay. What is the minimum payment required on this credit card? Okay, this is kind of, the answer is here, but it's 6167. So the explanation I gave you is if I pay 6167, right? My balance is not gonna grow more than the 2000, okay? Because my interest portion is not going to continue growing. If I make more than my minimum payment, I'm not only going to be able to eliminate my interest, but I'm going to start decreasing my balance and so on and so forth. Um, what is the remaining charging capacity on this credit card? This is a really good question. Who has the answer?
The available credit is 500.
Exactly. Exactly. That's perfect. So here is the answer. And another way of thinking about the remaining capacity on the credit card is credit limit, right? Which is 3,000, right? And how much you have spent on the credit card in total, it has to be 2,500 for your available credit to be 500. That's basically the math. Um, then what decreased the total amount owed from the previous month? There are plus minus two answers, depending on how you look at it. So number one is the total amount owed, okay, is before was 1,885. In reality, what decreased the total amount owed is the minimum payment, because if you're making your minimum payments, your balance is not, it's kind of like unable to continue growing. So that's part one. And two, payments, right? Like if you're making payments to your card intra-monthly, like if you started with a previous balance of 1,185, assuming don't worry about all of these items. If you started with 1,885 and you made a $50 payment in the month, your balance is 1,885 minus 50, of course, because then you had transactions of 100, your balance went up by 50 because you made 50 more of transactions than of payments, but you get the idea. Um, what increased the total amount owed um, from the previous month? That's very straightforward, is the transactions. That is A. And then in a more conceptual sense, look at this here. Fees charge and interest charge. That is added to your balance, the fees and the interest. So the reason I gave you that golden rule of don't pay for something that you cannot pay back on your credit card or buy something is this is the reason. Let's just say you buy a code that is worth 1,885 and you cannot pay it. Next month, forget about all the other big numbers, you're gonna owe 1,885 plus $40 of interest. So now you will owe 1,925 and so on and so forth. Like that number will just keep increasing because the next interest that it's going to be charged, your new balance is 1,925 and you're going to calculate the interest on top of that and on top and on top and on top. So you get the idea. Um, what is the impact of paying only the minimum amount required each month? As I mentioned, it eliminates your balance from accruing interest. Um, and this is a very good example here. If you make no additional charges using this credit card, just so you have an idea of like how long it takes to pay off stuff using minimum payments. Um, right now you have a balance of $2,000. And if you're making your minimum payment of $62, uh, it will take you 16 years to pay that money back, which is a crazy amount. And then B, you will end up paying 3,485, almost 3,500. So you end up paying 1,500 more than what you actually borrowed. And the answer is, well, What is the difference between the 3,500 and the 2,000 is the 2,000 you can think about as like your balance, and then the 1,500 extra that you're paying, believe it or not, it's all interest. That's why I say that this is a very expensive way of borrowing, and you should not borrow with this unless you can pay it back at the end of the month. If not, you're gonna be in a cycle where it just keeps topping off and increasing. And then what is the interest charge on purchases? Is this amount also charged on, sorry, I can't see it, on fees, interest? Um, who has that answer? The interest rate on purchases. Any idea?
25%.
Perfect. 25%. Exactly. So imagine every time that they're lending you money and you're not paying it back, it's gonna accrue at 25%. Think about that for a second. That is very high. And back to my example of when you borrow money and like you want money instead of like doing a purchase, cash advances accrue at 30%, much higher than the 25%. It's insane. That's why I said not a good idea. Okay. Um, any questions on this? Is this all clear? Any like no logical questions? Okay. Um, available to spend. Um, wait. I think I only get to do one activity. 1 second, because uh reading a credit. Yeah, yeah, that was the end of it. Sorry. This is for Chris to do because this ties up into the other activities. Chris, I'm sorry I took so long, but I did want to make sure that like
Not at all.
people
Well,
understood everything. So floor is yours.
these are great topics, and I know next time we'll be covering identity theft, but if any of these topics, if we don't get to some of the slides by the 7:30 mark, we can cover them next time as well. So let me share my screen. 1 second. Okay, so all right. Can everyone see the screen? All right, I see heads nodding. That's great. So Gabriel talked a lot about credit card, how it works, how to use it. I'm going to talk about what happens when you fall into credit and debt issues and some of the steps that you can take, although at times seemingly insurmountable, to help repair your credit over time. So first, we have a couple just key high-level overviews on what you can do to help repair your credit. So this is maybe you have a balance that you're carrying on one of your credit cards, as Gabriel mentioned, that's accruing interest over time. And some of the things that you can do are make sure you start using just one credit card. An issue we see a lot is people will use multiple credit cards. Gabriel mentioned there's signups, it's confusing, and you'll have a little bit here, a little bit there. So it's not necessarily that you have an issue in repaying the cards, but maybe you forget that you had a Bloomingdale's card and you had made a purchase on that card because they offered you a store card, and then that accumulates interest. And so all of a sudden you have interest there, and then you have interest on an airline's card. So the thing you can do at the beginning is just here we put cut up all the credit cards except one, but literally get rid of all the credit cards. Now, it's very important to note that getting rid of a credit card does not alleviate you of the balance. So do bear in mind that the money you spent, you have to pay back. and the interest accumulated with it. But it can help you focus your spending on one card, which helps hopefully figure out what you are spending and keep everything in one place. The second is switching back to cash. So if you feel like you're having issues with credit and you're accumulating a balance, cash is a great way to limit that spending. We talked about last time that credit cards extend you credit. So you can spend more, as Gabriel mentioned, than you conceivably you make or you're taking in. Cash is cash. So if you spend the cash, it's gone, and it can help limit some of the spending activity immediately. Additionally, we have paying down debt. We're going to talk about some of the debt management strategies, paying down the highest interest or snowballing. We'll talk about those later, and credit counseling as well. One interesting anecdote is that we were doing this class one time, and a student literally froze their credit card by putting their credit card in their freezer and freezing it so they couldn't use it. I don't know if I'd recommend that, but that's just another out of the box strategy to stop using the credit card. All right, so let's do a quick poll. And since I don't have any fancy polling software, what we'll do is if you can respond in the chat with just what you think the answers are one by one, that would be great so we can get some audience engagement. So first, have you ever reviewed your credit report? Type A for yes and B for no. All right, so I'm seeing a lot of A's so far. Lori, Andrea, Adrena, Karen, a lot of yeses. That's really great. I like it. If you haven't and your answer is no, that's okay. But reviewing your credit report is great. Not just because it can alert you to where you have balances, which often if you have a big balance on a credit card, I know personally, I'm fixated on it and I'm trying to make sure I pay it down or trying to make sure I pay it off. But oftentimes it's those lurking credit cards we talked about. It's the installment loan that you had thought you had paid down. It's for me and my wife, it was a student loan that we didn't realize we hadn't fully paid down yet, and there's still a balance outstanding. All of that can be answered on a credit report. Not to mention what we'll talk about next time, any issues with identity theft where people are spending money or spending your credit or damaging your credit. All that is great to review on a credit report. And it's never been easier to obtain and secure your credit report so that you can review it personally. We'll talk about how to do that a little bit later. All right, polling question number 2. How many free credit reports can you receive per year? There we go. 1, unlimited. All right, we have a bit less, we have a little bit less consistency here. 3, we have another 1. Any other responses? 3. Okay, so this is a little bit of a loaded question because I believe the answer that we'll talk about later is you can get 1 free credit report from each of the 3 main bureaus. So I'm going to give credit to anyone who answered B or C. So congrats to both the B and the C's. So there are 3 credit bureaus, Equifax, Experian, TransUnion. So you can get a credit report from each of them once every 12 months. So 1 credit report from each of the bureaus. All right, last question. Which of the following do not directly affect your credit score? All right. B, education background. All right, lots of Bs. You guys are on it. That's correct. So everything else, work history, payment history, length of credit history, amount owed, all that in some way will have a impact on your credit score. But as I'm sure we all know, there are plenty of very successful people that do not have a degree and vice versa. So that sort of success of income or the amount of money that they have, their ability to pay back debt or not debt, none of that is influenced by education background, and so won't affect your credit score directly. Nice job, everyone. Okay, so credit reporting, and this is where we have the nuance. So under federal law, you're entitled to receive a free credit report every 12 months from each reporting agency. So in theory, you could ask one from all three, or you could just get one from one agency. You can also get a free report if you've been denied a loan or job or insurance policy based on your credit report, you're unemployed, public assistance, or your report is inaccurate due to fraud. So, for example, if you find out that you're a victim of identity theft, there's some sort of some hack and your data got stolen, you're allowed to obtain a free credit report. And this is a comprehensive credit report. So it's a multi-page document. It has all of your accounts that the agency knows about, the balances it has for those accounts, the length of time that those accounts have been open. You can also check your credit score, which we'll talk about later. And I don't want to preempt that conversation, but I just want to make the point that if you go into an app, for example, a Citizens Bank app or something like that, and you have the option to see your credit score, that is different than this, which is pulling your credit report. And I just want to make that very clear. So it's not like you only can tap on that button once a year and see your credit score once a year. It's a different construct. Is everyone familiar with checking their credit score? Wonderful. Very savvy group indeed. So to get your credit report, there's a few different ways. What I would be very cautious of is making sure that you are actually trying to request your credit report from the right agency. So, and what that means is if it's Experian, TransUnion, Equifax, etc., it's all great. Annual credit report is a website that we recommend. We have the contact information on the slide, but there's a lot of obviously malicious actors in the world that will pretend to give you a credit report, but in reality, they're just trying to steal your information. So annual credit report is a site that we recommend. You can also call up the agencies directly or reach out to the agencies directly, and they will have different resources and ways that you can access your credit reports. So, but just do be mindful that there are people out there that are trying to take advantage of the fact that people are soliciting credit reports. Cincy, I see a question.
I just want to clarify, are you saying that that annual credit report that you're showing on the screen now will give you a report of all three?
I think you can pick and choose.
Okay. Okay, thank you.
I personally, when I've pulled it in the past, I've gone to Experience website and they have a very easy to use portal to access their credit report.
Okay, great. Thank you.
I have a question
So,
about this too, real quick, Chris.
of course, Sally.
Is this every 12 rolling months or annual year?
I believe it's every 12 rolling months.
Okay. Thank you.
So a few things, we have a slide in the appendix. I won't jump to it in the interest of time, but a couple of things to be mindful of on your credit report. One is obviously checking all the account information. So making sure that if there's an account listed, it is your account. What people often do fraudulently is they'll open up credit accounts in your name. So they may open up a mortgage, they may open up a phone line, they might do a credit check into or open up a credit card. So ensuring that all those accounts are correct is important. Ensuring that the payment history is correct is important. Now, this might not be fraud. It might just be a case of misreporting, or maybe you actually did miss a payment, but you want to make sure that that lines up appropriately. And also looking at the inquiries. So anybody who's pulled your credit report recently, so they'll tell you how many times it was pulled, etc. You want to make sure, obviously, that you're the only one that is pulling it. Lastly, just any personal information. So social security number on it, your birthdays, employment information, name, address, phone number. You want to make sure that's all correct as well. Okay. So, and the reason this is important and why we go to such lengths to try to ensure that your credit report is correct is because it's not just used for your mortgage, for example. It's used in so many ways, and in my opinion, personally, will continue to be used in a plethora of ways going forward. These credit agencies are in the business of trying to get their reports used by anyone. So, it's not just your mortgage anymore. It's anyone. If you're, buying life insurance, they'll pull your credit report. Car loan. If you're applying to buy an apartment, the co-op or the building owners may pull your credit. Landlords, your prospective employer might pull it. There's a variety of different uses. I mentioned the phone one, which is phone lines. Anyone who extends you credit or wants to check your payment history in any way may pull your credit report. So it's important to have it accurate because the last thing you want is to be denied an apartment, not because of your willingness to pay, but because some landlord pulled your credit report and saw a payment ding whenever ago that might not even be accurate and feel like you didn't report something correctly. Or they're looking at, your reported statement of assets and liabilities and they see the credit report and there's something on it they don't recognize. So that's why it's so important. Any questions on that? Okay. All right. So bankruptcy. If you file for bankruptcy, it will remain on your credit report for 10 years. And this is chapter 7 because what that is a full liquidation bankruptcy. So this is you can't pay back your debts, you file for bankruptcy, and then you liquidate and figure out ways to basically pay off all your creditors at a lower amount. There's another bankruptcy called a 13 bankruptcy that or is often called like a wage earners plan. And so that enables you to repay all or part of your debts rather with your wages or income that you're driving versus just a liquidation of your assets. So that will remain on for 10 years. That's why any sort of bankruptcy declaration should be taken with the utmost obviously it's a very serious occasion, but that's why we try to avoid it at all costs. Additionally, late payments or missed payments will stay on your credit report for 7 years, along with any liens or judgments. So again, this is all just reinforcing that things that may seem minor in the moment, like you missed a payment by ever so many days, and all of a sudden you forgot about it, years go by, and then a collection agency takes it up, that will stay on your credit report for 7 years. So again, important to make sure you're on top of it. Okay, so I'm sure you all it sounds like you are all familiar and have credit cards. You've probably seen a lot of these fair reporting credit standards before your eyes, but just didn't recognize. So oftentimes in any sort of credit statement, they'll have fee disclosures and they'll tell you, as Gabriel was pointing out on that worksheet, they'll show you if you just pay the minimum payment of $20, it will take you 30 years to pay off the entire balance of this credit card with interest. And they'll show it to you over 3 years or what extra payments would be required to pay it off over 3 years. Any sort of interest rates change, they'll send to you whether or not you have a drawn balance, and they'll tell you about late fees or interest penalties. So for most of us, 80, 90% of what we see, all this should be the banks, the financial institutions, they should be practicing these laws. But if for any reason you owe uh, some debt or you have a credit card and you're not sure about these, know that it's your right and in your interest to ask these questions and that you're owed the answers. Yes, Karen has a good point. Many times, if you call and ask, they will reverse the late payment fee as long as you don't abuse it. That is absolutely correct, Karen. It's not something I would bank on per se, but I think for the most part, especially if you have a long tenured history with a financial institution, they know how onerous it is for you to miss payments, et cetera, or have late fees, whatever it might be. So it's always, always, always worth it in a first line of recourse to ask, figure out if, hey, I was supposed to pay it on Friday, I forgot, and it's Monday or Tuesday, can I get this fee waived? Great point. Any other questions? Okay, let's talk about credit scores. So I saw some head nods, but how familiar are you all with credit scores? Have you all looked at your credit scores? You can comment in the chat. You're welcome to yell out. Okay, familiar enough. So in general, it's a score that goes from 300 to 850. And the way to think about it is the score is a composite of a variety of different factors, and we'll show that on the next page. I'll jump there now in the interest of time. The most important on your score is your payment history. So if you do nothing or take nothing else away, paying on time can never go wrong, as Gabriel was saying. It's the golden rule. If you pay on time, you avoid interest, and your credit score will be higher. The second, and one that I don't think people often register as much, is the amount owed. And so almost in an odd way, it actually helps to have more credit or more credit cards or a bigger line of credit to help limit the amount owed within reason. So what that means is, let's say you've had a credit card for 10 years, you have about, you can borrow up to $3,000, let's say, and your income is growing and your spending is growing. And so all of a sudden you're spending $1,000 a month on that credit card. That's a third or 33% utilization. So you're using a third of the credit allowed. That's a very high amount according to the credit agencies. So what I would recommend is asking the bank for a credit limit increase. And oftentimes they will grant it, especially if you have a strong, consistent history of payment and you're a good customer and don't have any outstanding balance owed. And what that does for you is it doesn't cost you anything other than maybe a credit check or something like that. And it will decrease your utilization. So if you can get it moved up to 5,000, let's say, for example, you still spend it consistently at 1,000. Now your utilization is 20%. That will increase your credit score. Of course, this is within reason. I'm not suggesting that you should go out and get 15 different credit cards. That's not a great idea. But that's a simple way, especially if you haven't done it in a while, that you can decrease your overall or increase your credit score and decrease your utilization. The other ones that, of course, you have less of an impact or you can impact less in the short term is the length of credit history. So the longer you have an account, the better. And our one piece of advice there is if you have a credit card and you find yourself not using it, so maybe, you haven't used it in a while, in general, if you can manage it, leave the account open. because when you close an account that you've had for a while, it decreases your average length of credit history and it lowers your score. That's something obviously you have to weigh in balance with the fact that you might not want this credit card anymore. It might be charging you fees, all the things. But in general, try to keep those accounts open, especially if they have no borrowings against them. Lastly, applications for new credit and mix of credit. Mix of credit is generally seen as a positive. So having a mortgage plus credit card plus an installment loan, a diversity of different types of credit is seen as a positive to increase your score, plus an auto loan. It just shows that you can pay back different types of credit. And then applications for new credit will decrease your score. So every time you open up a new account, a new loan, it will decrease your score slightly. Having a very high credit score helps you lower your cost of borrowing. So if you have a higher credit score, it means you're a better credit risk, which means from everything from a mortgage to an auto loan to anything that has to do with borrowing, they will give you a lower interest rate and you will have to pay less. Anyone have any strategies or thoughts on how they manage their credit cards? I remember last time someone said they had 8 credit cards. I know we're coming up on time. One one more tip on credit. I would be very cautious about when opening up new credit cards frequently, because not only does it impact your credit score, but if they have to do a hard pull and a credit check, that kind of activity as well goes on your credit report. Okay. We talked about these. I think we mentioned everything here, so I'll skip this slide. And maybe I'll end on credit comparison questions, and then Gabriel, next time we can talk about the debt management and pick up from there. I see Karen, sometimes I make a small charge on the credit card I don't use just so the institution can't close it. That's a great idea. If you leave an account at zero balance for a long enough period, they may just close the account because they don't want it outstanding if you're not using it. So making a small charge can be a great way to keep it open. That's a good tip. Sally, did you have a question? Okay, no worries. So I'll leave you with this last slide. When you think about what a lot of you sounds like you have credit cards, so that's great. As you think about what credit cards you want, if you want a new credit card, these are different questions you can consider. I won't spend a lot of time on it, but you should think about everything from the fees, such as the annual fee. Some cards have very high benefits but also have conversely very high fees. The APR, so if you do carry a balance, what type of interest rate are they charging? Grace periods between the interest rates being charged, the interest being charged, introductory rates, if they have balance transfer options, any sort of other fees, the late fees, the processing fees, etc. So there's a variety of different factors, but I think what I would think first and foremost when opening up a new credit card is what's the purpose? So if your purpose is I want to get these benefits, whatever, then is it justified by the fees that you have to pay or just the mental, hurdle of keeping that? Okay. I'll stop there. Any other questions on credit card, credit? We'll cover the debt management next time, so apologies for not getting to that, as well as identity theft and identity protection. medical debt. So that is interesting. Do you mean, Karen, as far as if it's included in your credit report?
Yes, I know that for a while it was not going to be included in the credit report. And I think I've been reading, I read so much financial news. I think I've been reading lately that that's going to be eliminated, the elimination of it. I should say that's a double negative.
I think I believe it is going to be eliminated. However, I think it's still being contested and debated as part of whatever the latest legislative version is of the One Big Beautiful Bill. So I would I would say in terms of incurring medical debt, in general, it's not people. I find that it's not something that people endeavor to collect. Like it just happens, and then it's generally a problem. Versus other forms of debt like credit card debt, where at least it's a bit more manageable and you can control the spending. It's very hard to control your health. So I think it's, as far as I know, I think it's still treated, or it may not be reported on your credit report. I would have to verify that. I'm actually not sure on that one. But the collection process isn't the same as a credit card, for example. It's, the hospitals tend to have a longer period before they can get paid back and less of an ability to assess interest than your credit card provider or banking institution would. So the amount won't change as dramatically as it could, if you left that same credit balance outstanding on your credit card over time. Needless to say, I think unfortunately, in where the climate that we live in, you'll still you'll still have hospitals sell their debt to a collector and they'll chase you down for those amounts owed, which is unfortunate. All right. Well, we're right at time. I appreciate you all for attending today and hopefully you found this helpful. If there's any other questions, we'd happy to stay on for a minute or two. Otherwise, great. It was great to see you all today.
Yes, thank you, everybody. Thank you, Gabriel and Chris. This was extremely informative as usual. So